talk about doubling down. This is managing risk to reward. One thing you can do is do nothing. I know it doesn't seem like a very good trading strategy, but a lot of people will do that. They'll just wait for their option to expire and do nothing. Another way you've probably heard of is rolling out the expiration month to the next month, which will cost you a little bit of money, but you might be able to save and not lose your 100% that you initially invested. Another way that also costs you a little bit more money would be rolling up to the strike price. So if you sold at $50, you would roll up maybe to the $60 level, and again, it would cost you a little bit of money, but potentially you wouldn't lose everything. Another way people do it is stop losses. But with high IV, as you probably see, there's a crap load of whipsawing happening, which brings me to my favorite source, which is doubling down, which I'm not doubling down just to double down. I don't want to keep on putting money at risk foolishly thinking that I'm going to win sometime. This isn't Vegas, it's a trading system. But think about it like this. If I had a house in a $100,000 neighborhood and I sell it to you for $50,000, you move into the house, you're happy, you made a good investment. But do you see that $50,000 of equity right away? No. Then the neighbor comes to you. He says, hey, I'll sell you my house for $40,000. You don't go, oh my gosh, I can't believe it. I just lost $10,000 on my investment. No. What do? You buy his investment also. And then you wait for the returns. A lot of times when we're in an option trade, we sit there and we see that we're negative 20, 30%. And we say, oh my gosh, and we get all anxious about the trade because it's real money. But think about that from the case of the scenario. The guy comes over and says, hey, I'll give you my house for $40,000. You could take that information and say, I just lost the opportunity. I could have saved 20%. And just because your trade goes negative doesn't mean that you're going to lose, kind of like the scenario of the house. You didn't lose anything. You just didn't buy the absolute best price. So now if price goes to another resistance level, you can buy again at an even better price. And now you have two trades, which in the story you'd have two houses. So here's some things we need to consider when doubling down. Doubling down entry, we need to wait 2 or more days. Next is, did we make a new resistance level? Again, if we're down 20 or 30%, that's okay. That doesn't mean we've created a new resistance level. Second is, we need to make sure that we're maintaining a high IV. 80% or more. Doubling down means just that. We need to raise the initial trade value. In our case of using 1%, that would be 2%, or $100 to $200. And then we need to even consider using the next expiration month. I would say minimum, make sure you have a 30 days. So we're resistance traders, and price comes up into this resistance. We bought here. Price kept going higher, giving us a new resistance area, which is equated by range boxes. Another way to calculate is if we bought against this old resistance and price kept going higher, we could duplicate this angle up here. So when price comes into that, we could double down. Kind of like space, we saw this long-term horizontal level along with this support line. Old support makes new resistance. So we placed a trade. Holy moly, were we wrong. We did not hold this resistance area, but we came into a new resistance area, giving us another opportunity to take a different trade. So we put out an alert to double down. And you can see we're down 11% today, which means we're profiting. ASAN, I'm down 25%, $60, because I saw this range box duplication up into resistance. You see we came above that resistance, causing me to be negative. I'm also up against this diagonal resistance channel. So I can either duplicate this range box up or duplicate this channel line. And unless price comes into this $80, I can't place another trade. Even if it breaks over this resistance line, I have to be patient, waiting for price to come back down below my break even. Unless price comes up into this resistance zone. I know this doesn't make sense. I'm more interested in about the probability of hitting against resistance and falling back down, sell the news, than I am about making sure I don't have too much at risk. That's where it comes into the 1% rule. At the 1% rule, I know I don't have that much at risk. Even if I lose in the trade, that still means I have 99% of my capital to make other trades on a very high probability trading system. Protect yourself by using 1% and only doubling down when you're at a new resistance area. There's a lot of emotions that go in with trading. I hope this will help balance out some of those emotions. We're more interested in making money than being emotionally reactive by what's happening around us.